Main Street Capital is often called the crown jewel of the business development company sector, but today we are going to strip away the hype to see if it is still worth your capital in July of 2026. You are looking at a stock that has built its reputation on reliable monthly dividends and consistent growth in net asset value. For years, it has been the go-to income engine for retail investors who want to avoid the headache of volatile tech plays. But holding a BDC right now is not as simple as it was 5 years ago. Interest rates have shifted, and the broader credit environment is forcing every income investor to ask the hard questions. Is this dividend machine actually durable, or are you walking into a yield trap dressed up as a blue chip financial? Today, I am breaking down the bull case, the bear case, and the latest quarterly data that just dropped. If you are holding Main or considering a position, you need to understand the structural risks and the real-world performance metrics that are driving the stock right now. This is not just a review of the charts, it is an audit of the investment thesis itself. Take a look at the performance chart for my Main Street Capital position. You see those 4 distinct steps early this year. That is not just a stock price moving. That is me actively executing a major pivot in my investment strategy. For a long time, I was caught up chasing high yield at any cost, which just led me into traps that were constantly eroding my net asset value. I finally stopped and realized that a high dividend means nothing if the underlying asset is crumbling. So I started shifting that capital out of those unreliable high-yield positions and into stable, reliable compounders. Main Street was the first big move in this transition. I currently hold 168.32 shares with an average cost of $53.57. That holding is now worth over $9,300, and it generates roughly $45 in passive income every single month. But this is just the beginning. My plan is to keep pruning the unreliable, volatile assets out of my portfolio and moving that capital into stocks and ETFs that I can actually trust for the long haul. This is about building a foundation that survives the market cycles instead of chasing the next flash in the pan. The bull case for Main Street Capital starts and ends with its operational structure. Unlike most BDCs that are externally managed, meaning they pay high fees to an outside firm, Main Street is internally managed. This is the single biggest competitive advantage for shareholders. You are not bleeding cash to pay external consultants or managers who have no skin in the game. Instead, you have a lean cost structure that allows more profit to flow directly to your pocket. When you look at the fundamental metrics, the story is undeniably strong. As of July 2026, the company has posted its 16th consecutive quarterly increase in net asset value per share. That is not luck. That is the result of a deliberate strategy focused on lower middle market companies that are resilient even when the economy tightens. These companies are the backbone of the American economy, and Main captures the upside by providing the debt and equity capital they cannot get from traditional banks. Investors who are bullish on Main are betting on the management team's ability to navigate credit cycles with precision. They have a track record of maintaining their dividend through the pandemic and various interest rate hikes, while other BDCs cut payouts and saw their share prices collapse. Furthermore, the company's access to capital remains elite. With an expanded revolving credit facility now topping $1.24 billion, the company has the liquidity to hunt for high-return opportunities when other firms are forced to deleverage or sit on the sidelines. You are buying a premium asset that has proven it can grow its NAV while paying you a monthly income. For an income-focused investor, the bull case is simple. You are getting best-in-class management, a consistent history of dividend growth, and a portfolio that has historically weathered the storm better than its peers. In a market where yield is hard to find without taking on junk bond risk, Main Street Capital remains the standard for quality. Let's address the bear case, because it is louder now than it has been in years. The fundamental threat is the interest rate environment. BDCs thrive on the spread between loan earnings and borrowing costs, but that spread is tightening. As borrowing costs rise, margin squeeze becomes a direct threat to the dividend. We are already seeing a deceleration in earnings per share growth, which suggests the easy gains are behind us. Furthermore, consider the concentration risk. Main Street is heavily invested in lower middle market companies. If the economy cools and those businesses default, the loan portfolio takes a direct hit. You cannot ignore the potential for markdowns on these assets, which would drag down the net asset value and force the stock lower. Finally, look at the valuation. Trading near its historical average price-to-earnings ratio leaves very little margin of safety for new capital. You are paying a premium price in a challenging credit cycle. The bear case is simple. The stock is priced for perfection in an environment where perfection is increasingly difficult to achieve. Let's look at the hard data from July 2026. The most significant news is the release of preliminary second quarter results, which were made public shortly after the end of June. The market responded to these results with cautious optimism. Main Street Capital reported continued growth in net asset value, which confirms that their underwriting standards are holding up despite the macroeconomic headwinds. Crucially, the board of directors declared the regular monthly cash dividends for July, August, and September of 2026 at 26.5 cents per share. This represents a 1.9% increase over the second quarter and a 3.9% increase compared to the third quarter of 2025. This dividend hike was confirmed in early May, but it is now being paid out as of July 15th. The ex-dividend date for this current cycle was July 8th, and the payment date was July 15th. This is important because it shows the company is prioritizing shareholder returns even as the income environment softens. Additionally, the company's recent move to expand its revolving credit facility to $1.24 billion is a massive catalyst for the second half of the year. This gives them the dry powder to execute new originations without needing to issue dilutive equity at a bad time. Another critical piece of information is the total cumulative dividend payout. Since their IPO in 2007, they have now paid over $50 per share in cumulative cash dividends. This is a massive psychological and financial milestone that reinforces their reputation as a long-term income compounder. However, investors need to watch the upcoming earnings call closely. The consensus analyst rating remains a hold with price targets ranging between $50 and $67. The fact that the stock price has recently oscillated in the $53 to $55 range tells you that the market is waiting for confirmation that the earnings growth can match the dividend hikes. If the upcoming Q2 earnings report shows even a slight crack in credit quality or a dip in distributable net investment income, expect the stock to test that $50 support level immediately. So where does this leave you as an investor? If you are holding Main Street Capital for the long term, the current dividend policy and the internal management structure remain the strongest reasons to stay the course. You are not buying Main for a quick trade. You are buying it for the recurring income stream that has proven its resilience over nearly 2 decades. However, if you are looking to enter a position right now, you need to be disciplined. You are paying a fair price for a quality company, but you are not getting a steal. Do not chase the stock when it is rallying near the top of its range. Instead, look for entry points during market pullbacks when the yield looks more attractive. My strategy is simple. I treat Main as a core income holding. I do not look for it to double in price. I look for the dividend to grow and the NAV to remain stable. If those two things hold true, I am a buyer on red days and a holder on green ones. But you have to monitor the credit environment. If interest rates remain higher for longer and the economy truly cools off, the supplemental dividends will be the first thing to get cut. That is your canary in the coal mine. If you found this analysis helpful and you want to keep track of how my own portfolio is adjusting to these conditions, make sure to subscribe to the channel. I share my live trade alerts and my monthly dividend reinvestment updates every single week. What is your take on Main Street Capital right now? Are you adding at these levels or waiting for a pullback? Drop a comment below and let's discuss the strategy. Thanks for watching, and I will see you in the next one.